TSLY has an 87% yield. Can you really double your money in just over a year? Or is there some sort of catch? Spoiler alert, there's some sort of catch. Actually, there's an entire ocean worth of catches. But just because it has risk doesn't mean it can't be a good investment. So let's dive in and take a little deeper look at TSLY. At its most basic level, TSLY is a covered call ETF that invests in Tesla and sells call options on it. Or, well, a much more complicated version of that. A normal covered call strategy would involve buying a stock, then selling a call option on it. If you're new to those, here's a 30-second recap of how they work. A call option gives the buyer the right to buy a stock at a set price. Of course, they'd only want to do that if the stock goes higher than that price. So if you're selling those options, like TSLY is, that means someone else gets to benefit from the upside in Tesla if it goes up a lot. That means you get a little of the upside potential. But then anything beyond that set price, which is called the strike price, you give up. And what do you get for giving up your upside potential? A massive income check. And that is why people buy ETFs like TSLY. TSLY is a little different than other covered call strategies though, because it doesn't actually own any Tesla stock. Instead, it uses what's called a synthetic covered call strategy, which in layman's terms means it tries to replicate the Tesla position through options. That strategy has its ups and downs, but to be honest, I'm afraid I'll lose you if I start getting into option math. So I'll spare you the details. I also just think there are much more impactful things we should be focusing on. For example, the yield figures are pretty misleading. First, on the 87% yield, that's looking at the 12 months of dividends divided by the current share price. So since the price is down a lot, it's gonna look higher than it really is. Second, and more importantly, the share price will almost always be down a lot. So the yield will almost always look higher than it really is. This happens because with covered call ETFs, especially ones with an extremely high yield, a lot of the income is often characterized as return of principal. You can think of that as them saying, we're gonna give you some of your investment back. When cash comes out of the fund and goes back to the shareholders, that pushes down the share price. So if you don't choose to reinvest your dividends, your investment in an ETF like this will likely just dwindle away over time. You won't necessarily lose it. It's just that most of it will be returned to you as dividends and then sit in cash in your account. If you do reinvest the dividends, you should end up with more shares at a lower price per share, and then the value of your investment will reflect the actual return on your investment. That phenomenon has been the source of a lot of confusion among other people who have reviewed this video.
The dividend distributions for TSLY have also been decreasing ever since it came out.
Yes, but if you've been reinvesting your dividends that whole time, you'd have a lot more shares. Through March 2024, TSLY has paid out almost $21 per share of dividends. Without doing the actual math, I'd say its average share price has been roughly $25 to $30 per share when it's paid its dividends. So that means you'd have almost twice as many shares as you started with. The yield may have fallen a little, but not by more than half, like his chart showed. Here you can see how it can get confusing when you're looking at the share price or the growth of the investment if you don't know what you're doing.
If we compare Tesla stock with the Tesla covered call fund, their one-year share price performance has been pretty revealing.
The problem is he's showing TSLY's share price alone without the dividend, but almost all the return comes from the dividend, so this is completely misleading and doesn't tell you anything. If you look at an accurate return chart, you can draw some important conclusions though. Like most covered call ETFs, it trails the investment it supposedly tracks pretty significantly in market rallies. But unlike most covered call ETFs, it has actually trailed the investment even in a flat market. If Tesla stock is up 2% over a year and a half, a Tesla covered call strategy should be up more than that. That is literally the optimal market for these ETFs. Unfortunately, in reality, it doesn't work that way. The nature of covered call strategies is that they miss out on big gains and barely protect against big losses. They'd only do well if whatever investment they're tracking is roughly flat every month, not over a longer period of time with a lot of ups and downs in between. But if they were flat every month, then their covered call ETFs wouldn't yield very much. The yield is higher because Tesla is so volatile. So it's a bit of a dilemma. More volatility increases the yield, but it also increases the likelihood that something like this will happen. YieldMax even says so on the TSLY page of their website. The fund strategy will cap its potential gains if Tesla shares increase in value, but it'll be subject to all potential losses if Tesla decreases in value. In my opinion, that is not a good deal for investors. In the end, if you're positive on Tesla stock, you can capitalize on its growth potential much better by just investing in Tesla directly. If you're negative on Tesla stock, then in my opinion, you probably shouldn't be investing in Tesla stock or TSLY. I can't imagine a scenario where I'd ever put any of my money in this ETF. If this is your first time here, I'm Kyle, and this channel is actually run by me and another person who is currently in the industry and is a CFA charter holder I used to work in the industry and left to travel the world and do some other things. But if you want to continue the conversation and get more investment insight, check out the link below to our free Discord. And also let me know if there's any other funds that you'd like me to do a review on or a fund comparison. Thanks for watching, and I'll see you in the next video.